Welcome, everyone, to today's Macroeconomic Explainer. Look, if you're managing institutional capital right now, you know we're sitting at a highly critical juncture in the markets. We're seeing a really sudden, glaring disconnect that is fundamentally reshaping how we view risk assets. For months, the prevailing wisdom was basically that Bitcoin functioned as this high beta proxy for the broader equity market, right? Moving in total lockstep with risk on sentiment. But suddenly, we're seeing that correlation just completely fracture. Bitcoin is trailing behind equities in a way that is literally forcing a major reassessment of institutional portfolios. So today, we're going to dissect the exact macroeconomic plumbing driving this divergence and honestly, what it means for your capital allocation strategy going forward.
Here's the roadmap for our explainer today. We're going to cover the great market divergence, inflation triggers portfolio pivots, mega-cap tech versus Bitcoin, treasury shifts draining liquidity, and we'll wrap it up with forward guidance and scenarios.
Section 1. The Great Market Divergence, the disconnect between indices and high-beta assets. Okay, let's dive right into this. Back on May 13th, the market threw us a very clear but very conflicting signal. Historically, traders have treated Bitcoin like a high-beta proxy for the exact same risk appetite that drives massive tech rallies. You know the drill. When equities have a huge green day, Bitcoin is supposed to surf that exact same liquidity wave. But that is absolutely not what happened. Instead, we got this shocking divergence. While the S&P 500 was marching upward, hitting brand new all-time highs, and flashing this massive headline risk-on signal, Bitcoin basically broke down. It lost its absolutely crucial $80,000 support level, dropping all the way down to an intraday low of around $78,760. So you got to ask yourself, how does a so-called high beta risk asset completely sit out a massive stock market rally?
Well, to understand that disconnect, we really need to look under the hood at the anatomy of this equity rally. It is incredibly narrow. The S&P 500 wasn't showing broad strength. It was green largely because just the top 10 stocks, we're talking giants like Nvidia, Apple, Microsoft, they were pulling the entire index up single-handedly. To put that into perspective, just 10 stocks now account for a staggering 36.5% of the S&P 500's entire market cap. And the fuel for this? AI. Goldman Sachs estimates that AI investment alone is going to drive roughly 40% of the S&P 500's earnings per share growth this year. The big cloud infrastructure companies are planning to drop about $670 billion in 2026 alone, so this is not some broad, healthy market expansion. It's a highly concentrated mega-cap tech phenomenon.
Moving to Section 2, inflation triggers portfolio pivots, the data forcing institutional capital to move.
Look, institutional capital doesn't move on sentiment or vibes, right? It moves on hard data. And the data print that changed the game here was a shocking 6%. That is the year-over-year jump we saw in the April Producer Price Index, or PPI. That's the largest 12-month gain in producer prices we've seen since December 2022. This wasn't just a minor blip on the radar. This was an alarming jolt to the system that overnight fundamentally altered institutional risk models.
So let's break down the actual mechanics of this macro catalyst. That April PPI rose 1.4% month over month, and energy really led the charge there, with gasoline prices spiking 15.6%. Now, when producer prices surge like that, it's a massive red flag that sticky inflation is still very much in play. Traders instantly digested this and sharply repriced their expectations for the Fed. The probability of a Fed rate hike by December suddenly surged from roughly 15% to 34.3% in just a matter of days. And as a result, Treasury yields and the US dollar both climbed aggressively. And right here, this is the core issue for crypto. For a non-yielding asset like Bitcoin, a rising dollar and climbing Treasury yields act as a direct, heavy tax on its valuation.
Section 3, mega-cap tech versus Bitcoin, cash flow durability versus liquidity dependence.
Look at the stark contrast in performance we saw from March 30th to May 13th. Nvidia gained an unbelievable 45%, driven by actual, tangible AI earnings, and that massive $670 billion cloud spend we talked about. The Nasdaq-heavy QQQ rose 28%, fueled by tech dominance and aggressive stock buybacks. But in that exact same window, Bitcoin crawled up just 4%, before totally losing its 80K support. The equity side was being driven by fundamental earnings, while Bitcoin struggled simply because it lacked a broad liquidity catalyst. The crucial takeaway here is understanding why capital acts this way under pressure. Mega-cap tech is cash flow durable. When the macro headwinds start blowing, these tech giants have earnings per share beats, clear AI revenue visibility, and massive stock buyback programs. They generate cash, and that reinforces bids even when interest rates climb. Bitcoin, on the flip side, is entirely liquidity-driven. Its price mechanism relies pretty much solely on broad liquidity expansion. It just doesn't have that earnings-based support, which leaves it super vulnerable when overall market liquidity tightens up. Right now, the upside is flowing almost exclusively to those cash-generating megacaps.
And without that broad liquidity expansion, Bitcoin's spot conditions deteriorated fast. Going into mid-May, spot Bitcoin ETFs actually saw multiple consecutive days of major outflows. We're talking hundreds of millions of dollars pulling out between May 7th and May 12th. Plus, perpetual funding rates ran negative for an astonishing 74 consecutive days. Just think about that for a second. 74 days showing a complete lack of aggressive long positioning. Daily spot volume was remarkably thin at around $2.7 billion, and it was consistently closing below its 200-day moving average. Look, in a market with thin volume, negative funding, and heavy technical overhead, an asset is going to absorb all of the macro downside unless some massive liquidity catalyst comes in to save it.
Section 4. Treasury shifts drain liquidity. The plumbing of the financial system.
Now, we got to look at the quiet forces really dictating institutional risk appetite right now. If we peek at the macro plumbing, the Treasury Borrowing Advisory Committee has laid out some massive projections for the Treasury General Account, or TGA. They're projecting the TGA will finish the third quarter of fiscal year 2026 at $900 billion, and then climb even higher to $950 billion by the fourth quarter.
So why does the TGA actually matter to a Bitcoin investor? Let's walk through the mechanics. Step 1. The Treasury General Account increases its balances to fund ongoing government obligations. Step 2. As that TGA swells up, it actively absorbs reserves directly out of the banking system. And Step 3. As those reserves get soaked up, crucial liquidity is methodically drained away from the broader market. And guess which assets suffocate first in a tightening liquidity environment? High beta, non-yielding risk assets like Bitcoin.
And what's compounding this liquidity drain is external commodity pressure. Oil prices are up nearly 80% since the start of 2026. This is classic supply-side inflation right here. So even if the equity market is partying on the back of AI innovation, the Federal Reserve's hands are completely tied by these surging energy costs. They literally cannot pivot to expanding liquidity when supply-side inflation is staring them right in the face.
Section 5. Forward guidance and scenarios. Strategic price targets for institutional portfolios. Let's break down Citi's strategic price targets based on how these macro conditions might play out. First up, the bull case. If that inflation shock fades, Fed hike odds drop, and the dollar softens up, we could see ETF inflows resume at scale. Citi's target here is an impressive $165,000 over a 12-month horizon. Next, the base case. If we assume inflation stays sticky but doesn't get severely worse, Bitcoin probably just chops around that $80,000 range, continuing to lag behind mega-cap tech. Then we have the bear case. This gets triggered if that hot producer price index bleeds into consumer prices, pushing hike odds up toward 50%. That would likely force a test of the $68,000 to $74,000 zone, which is where a ton of derivative liquidations are sitting. And finally, the adverse macro scenario. If liquidity tightens even further and this oil shock persists, deleveraging is going to accelerate, pointing to a much lower Bitcoin target of $58,000.
Ultimately, we really have to view the market through this one foundational lens. Bitcoin's valuation lives in the window between Fed liquidity and real rates. It's that simple. Until that macro window widens up again, until liquidity actually expands and rates ease, mega-cap tech is going to remain the preferred institutional vehicle. Tech's earnings durability easily bridges the disconnect that Bitcoin, as a pure liquidity asset, simply can't cross right now. So I want to leave you with this question to consider for your own strategy. Facing tightening global liquidity and this highly concentrated AI equity risk, is your portfolio properly calibrated to withstand an adverse macro shock? The data is telling us loud and clear that assuming a correlation between tech equities and Bitcoin is a deeply flawed strategy right now. It's time to reassess your risk exposure, keep a very close eye on Treasury balance sheets, and prepare for multiple macroeconomic scenarios. Thank you so much for joining me on this explainer, and I highly encourage you to take these insights straight to your portfolio models today. Catch you next time.